will indeed. In fact, let's pick up that discussion point exactly. Pranjul Bhandari, Chief Economist India at HSBC Securities and Capital Markets, joins us on the show right now. Pranjul, hi, morning. Great to have you on the show. Pranjul, it clearly seems it's inevitable that we are going to see a rate hike. More than the quantum, I think it's the commentary that, one is wondering what it's going to be. Because that's something that from the Fed to the BOE is what the markets nowadays have been reacting to. What do you think the commentary from Shaktikanta Das is going to be like tomorrow?
Yeah, well, I think there will be a mention of both the domestic and the external sector in sort of, equal weight. On the domestic front, the growth inflation mix, is it improving? Is it worsening? Is it getting more challenging? I think that will be discussed. The first quarter GDP, the June quarter GDP was a bit below consensus. Some sort of thoughts on that, what's going to happen to GDP going ahead. And then, of course, since the previous policy meeting, the rupee has weakened 3%. What could the impact of that be on inflation? What could the impact of the weak rice crop be on inflation? And therefore, where does that put the whole growth inflation mix? So I think that's going to be one part which the governor will talk about a lot tomorrow. The other part, my sense is, will be on the external sort of outlook, what's happening to growth, what's happening to the perception of risk, what's happening to some of the other uncertainties we have, like, for example, the still sluggish Chinese growth. What does all of that mean for the global economy and therefore indirectly for the US dollar and therefore also for financial stability in India? So I think both of these will be discussed a lot. In terms of action, I agree. I think it has to be a 50 basis points rate hike at this point. Almost all emerging markets are now trying to focus on large quantum rate hikes because of all the sort of common problems around growth inflation mix. My other one sort of point is that my worry is that growth, we don't realize now, is going to slow quite a bit from after Diwali. And in a way, we only have the space to hike rates for September and December meetings, these two meetings, because come 2023, and a lot of the discussion will be on growth, what do you do to revive growth? What can the budget have to revive growth and all of that? And then, the room for rate hikes will become much lesser. So I think the RBI is also going to focus on sort of giving this last push over the September and December meetings.
Pranjul, good morning. Nikunj also joining in. When we spoke to Governor last, and that was about 6 weeks ago, he did indicate to the fact that liquidity in the system is tight and the credit growth is lagging the deposit growth, which means that they need to be cognizant of not sucking out a lot of liquidity from the system. What would be the impact of this, liquidity and credit growth factor?
Yeah, so look, the liquidity has tightened a lot in the last couple of weeks. And I think there are three main reasons for it. I think the number one is the FX intervention that the RBI is doing, selling a lot of dollars in the market and draining out rupee liquidity. And I think that problem is likely to stay. Then there is the problem of the tax cycles, as in GST tax cycle, advanced tax cycle, which takes away liquidity, but that generally is temporary because hopefully the government will spend. And then there's a third problem, which is, I think, most important at this point, that the government is sitting on very high cash balances with the central bank, about 3 trillion rupees. Generally, during this time of the year, the government actually sits with zero. It actually has an overdraft with the central bank. But what we've seen through the pandemic period is that the government is not spending early on. Rather, it is spending towards the end of the fiscal year, around March. And then through the year, it sits on a lot of cash balances. We practically didn't notice this for the last 2 years because generally speaking, system liquidity was good. But this year, because there has been so much FX intervention, this government's sort of habit of sitting on too much cash at this point of the year is really hurting. So my sense is that I think this will be a conversation the RBI has with the Ministry of Finance, that why don't you start spending more, as in start spending regularly rather than lumped up spending at the end of the fiscal year, because that can help ease domestic liquidity stress at a time we are doing so much of FX intervention. So I'm hoping that is a fruitful conversation. And what we see, at least closer to the Diwali period, is some of the banking sector liquidity, rising.
Pranjul, if I look at the global setup, global central bankers, in a sense, they are ready to storm growth to manage inflation. But they're still looking at a lot of backward data and not looking at the recent decline in commodity prices. Do you think RBI could do it differently? Because the number what the governor gave us last time when we spoke to him, that RBI assumptions are based when crude prices were at $105. Crude prices are way below that. So do you think there could be a departure from what global central bankers are doing versus RBI tomorrow?
Well, look, we got this big commodity price shock in March, right? And since then, obviously, this whole pressure has been on the inflation pipeline. It's sort of advancing and hopefully it'll peter off at some point, but it is still there. As in, we are seeing it, right? We are seeing inflation pressures move from WPI to CPI inflation, from rural to urban inflation, from goods to services inflation. It's advancing, it's progressing, but it's still in the system. It's not completely gotten off. And then before that could completely even, have its own sort of process, we have this new shock of a bad cereal crop. Rice and wheat prices are high. And the problem with rice and wheat is that they are generally annual or biannual crops. They are not like vegetables that you have a bad crop and in 2 months you have the next crop, so it's okay. It's very hard to look through very easily when it's food grains, as it's easy for vegetables. So my problem is that suddenly, one shock is sort of petering off, but another shock has come. And this is a tricky shock because inflation expectations react quite a lot to food grains, to food prices. So my sense is that the RBI still has to remain careful on the inflation front.
Pranjul, hi there, morning. What about the outlook in terms of the strength and resilience that we're seeing in the dollar index versus other emerging market currencies? The rupee, for instance, 81.94 yesterday is the all-time low that it hit. Do you believe in comparison to some of the other emerging market currencies that the rupee is a little better off? And what is it that you're looking at by way of moves on the dollar index impacting other currencies?
So I'm going to answer this in two parts. One the dollar and the other the rupee. In terms of dollar, our sense in HSBC is that the strength in dollar is likely to last. It's going to likely to stay. And there are many reasons for that. One is that when global growth slows, then dollar strength increases. The other is a lot of risk of volatility in global markets. That is also a time when dollars it remains strong. Then we have still sluggish growth in China that generally tends to keep the dollar strong. We have commodity prices fall, but still well above pre-pandemic or 2020 levels. And I think all of these factors are likely to keep dollar strong. That is sort of one part of your question. The second part is, what about the rupee? Look, last 3 months, India's trade deficit has averaged about $28 billion a month. That's very high. We think that is also going to remain pretty high in September and October because we do a lot of pre-Diwali imports then. Come November, December, the trade deficit may narrow a little bit because oil prices have fallen and the impact of that will be favorable. So we could go up from about $28 billion a month to about $20 to $23 billion a month. But my problem is that 22, 23 is also a very high number. And then come 2023, we think again the trade deficit will start widening because exports will begin to slow. Now, we haven't seen the whole export story unfold. It's just about started. India's low tech and medium tech export volumes are slowing since June. High tech export volumes, which have been a huge driver of growth and BOP, have also started to slow since August. And I think that's going to be the big problem. Once exports start slowing, that problem could more than offset the benefits we are getting from our oil prices falling. Cutting a long story short, I think the trade, the current account, and the balance of payment is likely to remain in deficit for the foreseeable future. So all of that puts pressure on the rupee to weaken. Before I sort of say about how much or things like that, look, it's very clear to know that we are not in a crisis situation. We have a lot of FX reserves. We have about 9 months of import cover. When we were in close to crisis situation, that had fallen to 6.5, 7 months of cover. So we have a lot of sort of buffer with us. But yet, it's important to note that the dollar has appreciated 20% since the start of the year. The Asian region and the emerging markets region in general has depreciated about 13, 14% in the same period. The rupee has depreciated about 9%. So the rupee has been an outperformer right now, but because this problem is for so long and the RBI can't keep intervening indefinitely, our sense is that some rupee weakness is here to sort of continue at this point.
To have you on the show. Thank you for giving us all that in-depth perspective.